This girl right here lost $70,000 trading Moderna, and then she lost $47,000 on another trade, which equals $117,000. So this video, she's going to share her 4 trading rules that she developed after losing $117,000. Now, I don't know if there's anything that would make some person rethink their approach to something and come up with some rules for how to do things differently next time after losing $117,000. So let's hear what she has to say after losing $117K so we don't have to.
Imagine if somebody handed you a briefcase with $47,000 in cash and then set it on fire right in front of your eyes. It may seem unlikely, but that's exactly what happened to me when I shorted this IPO. Or imagine if somebody told you they can make you a lot of money and all you had to do was follow them. So you did, and then they end up stealing your wallet. That's what happened to me when I signed up for 5 different chat room alerts.
It'd be like that. It'd be like that.
The point of me telling you these stories is that I learned some powerful lessons from each one of them.
So let's see what we can learn from her pain. So hopefully we don't have to lose $117,000 ourselves.
I want to make sure that you don't repeat my mistakes. And from these stories, I've created 4 rules you need to become a profitable trader. I have
4 rules for becoming a more profitable trader. Let's see what we can learn.
personally broken all those rules in the past before, and that's cost me these fat lessons. $47,000 on Snapchat and $70,000 on Moderna stock.
And oh my God, isn't pain a good teacher? Oh my God, isn't pain, isn't the pain, the brutal pain of losing money, losing thousands and thousands of dollars, the best teacher? Oh, you better believe it.
As an elderly grandma, it is my job to let the new traders stand on my shoulders and better the craft of trading. So
She's funny.
climb on and get ready to learn from these 4 important rules to become a profitable trader.
Yes, Sensei, we are here to learn from your wisdom. The Trading Sensei, the Trading Sensei.
Welcome back to another Humble Trader video. For those of you who are new to the channel, welcome. My name is Shay, aka Humble Trader.
Nice
I've
to
been
meet you,
trading for
Shay.
over 8
Nice to meet you, Shay.
years now.
Training for over 8 years now.
My YouTube channel is for
She ain't no spring chicken, ladies and gentlemen.
you if you want a straightforward, no BS approach to day trading with actionable lessons and strategies.
Straightforward, no BS approach to trading. If you're my subscriber, you know that's how we roll. I like it.
I don't drive a Lambo because I drive something even more balling. My family's Corolla. So if you
That's amazing.
ever want to see
I hope that's true.
me flex with my Corolla on this channel, please do me a huge favor and smash a like button for me.
Smash the like button. We gotta see her flex her Corolla. That's amazing.
Okay, let's start with the first
I like this girl.
trading rule to become a profitable trader. Rule number 1, make sure you only have 1 or 2 indicators on your charts. Yes, you heard that right. Those pretty lines on your charts like the RSI, histogram, and Ichimoku clouds, they are probably not helping you. When I first started trading, I was told to use numerous indicators to assist me with entries and exits. Some really common ones include the RSI indicator, the MACD, cross, the 13 EMA and the 50 EMA pair, and even the infamous Bollinger Bands. So I spent months watching all these indicators and watching them cross. However, I neglected the one important thing that all momentum traders should know:
What's that?
observing price action.
That's right. In case you don't know this, you probably already know this, but in case you don't, all indicators, every single one of them is based on price action. They're all based on price action. So it's second tier, right? It's second degree information. Why not just look at the actual raw data? Open, high, low, close. That's all the information the indicators are based on. So what she's saying is look at the actual candlesticks, the open, high, low, close, and see if you can get to a point, or at least take on trying to understand that instead of just being a victim, a poor victim of your indicators. And why? Why would that be valuable? Well, here's the thing. If you use an indicator and do what it tells you to do, and then you lose money, you blame the indicator. That's where the problem is, right? So you can avoid that by actually understanding what the price action is showing you, because the indicators might actually be wrong sometimes.
Price action is the true indicator that's gonna allow you to find entries, potential setups, and see subtle changes in the sentiment. Then you can decide whether you wanna stop out to protect your capital, sell for a profit, or hold on to your position to
That's another brilliant point as well, right? She's saying the subtleties won't show up on the indicator, which is true.
To truly maximize your wins. So let me show you how I set up my charts and indicators that allows me to really focus on price action.
That's just such a brilliant point, right? Because your eyes will see subtleties that the indicators will not. And if you're quick enough and sharp enough, you can make money that way.
Okay, well, on my TradingView platform right now, let me show you how I set up all my charts and indicators. So as you can see, I have my left-hand side and right-hand side. With intraday chart, often the 5 minutes or the 2 minutes if I'm trading small cap stocks, and the left-hand side is the daily chart.
Okay, so this is exactly how I set up my chart as well. I've got the 5 minute on the right hand and the daily chart on the left. And she's showing you in TradingView. And TradingView, I believe, is the best platform for trading. So that's usually what this looks like on my chart. We can see that all of the price action up until the last 3 days was below, most of it, right? Almost all of it was below the EMA. But then as you can see in the past, 2-3 days, now we are closing above the EMA. So it looks like the shift in bias or a shift in sentiment. So there we go. That's how to set it up. And I like her message here, which is keep it simple, please. Now, why? Why is it important to keep it simple and not load up your chart with indicators? Because paralysis. Trading is nothing but decision making. You're essentially getting paid to make decisions. And if you have too much information, it will paralyze you and you won't be able to make a decision.
Because as traders, it's very easy to have tunnel vision and only see what the stock is doing intraday without seeing the bigger picture. So that's why it's so important to have your daily charts open on the left-hand side. So on your intraday chart, you're gonna have volume by default at the very bottom. All your platforms should have this. How you add the indicator is go to indicator settings, which you should have on your platform. So I'm gonna add the one indicator I use, which is VWAP. You may have to type in volume weighted average price on certain platforms and just click this to add the VWAP.
Okay, so you go to indicators and you add
A lot
indicators.
of
So
platforms
I think we
really
can probably
claim
skip this.
one line, which is the VWAP indicator we want for your trading strategies. Now,
So what she did is she just unchecked everything except one average indicator. Now the VWAP is a measure of the average price. The exponential moving average, which I use, is a measure of the average price. It's for all intents and purposes, most of the same thing. But a lot of times you'll get all fancy with all these different lower bands and higher bands. And she's just saying, get rid of all that. Have it be one. Keep it simple. I like it.
I want to change the look of my VWAP indicator. So you can do this on most
Yeah,
trading
and you can change the
platforms.
look,
You can
but I think you
actually
guys
place
don't waste your time.
much, but it just kind of shows me when I have a volume breakout that lines up with
Okay,
my,
down here, she's saying
with
she
my
uses the
VWAP
volume.
indicator. So you can do that. I don't think you can do this on all your platforms. So check your own platform. But on Dash Trader, what you do is go to your volume bar and go to configuration and display an average line. Okay, you can do this with Thinkorswim and Interactive Brokers. I don't know about the others. An average I use 13 moving average for volume. So whenever like volume breaks out on the selling side or buying side, I see it as well on this volume bar down below. So the key lesson here is instead of relying on memorizing patterns and a gazillion indicators to line up, I removed all of them and I became a trader who's more focused on trading price action. And I was able to turn my losses into more green days.
Yeah, because it tells you what the buyers and sellers are thinking. What's better than that?
So that's my suggestion for you as well. Remove most of your indicators. Keep one or two that you really like. For me, these will be the VWAP and the volume you see over here.
Right. And for me, it's the EMA and the ATR.
Way you can actually focus on trading your plan, which we're gonna talk about later on, and not get distracted by all those things lining up. If you have other indicator pairs that you like using, just one or two, let me know in the comment section below and I'll take a look. The next trading rule we're gonna talk about.
All right, number 2, let's see, what's her second rule?
Came from a painful lesson.
Add to position size gradually. Notice, gradually is highlighted.
During my second year of trading, I remember how happy I was after I started making $100 each day. I was excited and feeling really pumped. Finally, I'm seeing some consistent greens.
Oh, consistent green. What an amazing feeling.
Hey, $100 a day is $500 a week. Not bad for trading about only 2 hours a day and heading on to work.
Assuming you don't take any losses, right?
These smoke
Which is unrealistic.
gains definitely added up to build my small account. And remember, I was still making a good income for my full-time 9-to-5 job at the time. Then I started thinking, hey, if I just size up my shares by adding a 0 to my share sizes, basically using 10x my
Oh my God. Bad idea.
normal size. Then I will be making $1,000 a day. That's $5,000 a week. I will be banking. I'm sure you have thoughts of this.
And I've made that mistake as well. It's like you start doing well and you start doing the math in your head. You're like, okay, twice as much, 4 times as much, 10 times as much. And then it's just like in your mind, all you see are dollar signs. All you see are increases, but you don't see the obstacles. You never see the obstacles in your mind. You just see the good stuff, but not the bad stuff. That's tricky.
This too, right? I mean, I couldn't have been the only trader who has ever thought of this genius idea.
Yeah, right. I think
Well,
it happens.
that's-
I think it happens to all new traders, right?
Just say this overconfidence with sizing up didn't really end up that well for me.
Okay, so she pointed it out. This is a mental game trading psychology trap. Overconfidence. Probably the most lethal trading psychology trap. Overconfidence. If you want to read more about this and go to the expert, Jared Tendler wrote a book called The Mental Game of Trading. Read it. He's helped me enormously. I've been working him for a couple years now, and there's no one better, in my opinion, alive, other than Mark Douglas, but he's dead. So go to Jared. Just restart with reading the book, The Mental Game of Trading.
Not only did I lose all the small $100 profits from the last few weeks, I completely blew up my account.
Ouch.
Because you
Ouch.
see, I did not take into consideration the emotional stress that scaling up would create.
It's such a good point, right? In your mind, you go, oh, I'll just keep doing the same thing I'm doing now and add a 0 or whatever, right? But you don't go, oh, okay, well, what about how that's going to affect the emotions? How is that going to affect my trading psychology? How is that going to affect me here? And you really, until you've actually traded big size, you cannot wrap your head around it. You cannot wrap your head around the kind of emotional stress that she's talking about. Going from, say, $100 risk on a trade to, say, $1,000. It's unexplainable, that kind of pressure. And you have to ease yourself into it, which is what she's getting at.
If my risk was only $30 to $40 a day to make $100, suddenly now my risk is $300 to make $1,000. And yes, while I wanted that nice number of $5,000 in 1 week in my trading account, I was not ready for the thousands of losses. And those position sizes, when scaled up way too quickly, they'll lead to emotional trading. So here's the key takeaway. Traders, please consider taking your time when sizing up. Give it a couple of weeks or months before even adding a quarter size and then 2 times your size.
And I'll share with you the rule I used, which is from the grandfather of price action, Al Brooks. He said, start with trading 2 of anything. If it's futures, 2 contracts, right? Whatever you're trading, limit it to the size equals 2, okay? And don't go over that, okay? If you got the kind of cash to be trading E-minis, that'd be 2 E-minis. If you got the kind of cash to be trading micro E-minis, that'd be 2 micro E-minis, okay? And then do that until you start becoming consistently profitable, and then slowly increase. Remember the tortoise and the hare? They say slow and steady wins the race. Remember that one? Slow and steady wins the race here. And not only that, but if you don't go slow and steady, it's almost guaranteed you'll blow up your account.
Let me show you a good way right now to calculate how much position size to take or gross account exposure you can take according to your account size. And this is especially important for managing your risk when you're trading a lot of different kinds of stocks. Let me show you how. So on the screen right here, you're looking at the Humble Trader account risk calculator. So you can get this for free by signing up for my weekend $100 per trade. If you are more aggressive, you can look at 3% or even 5%. I don't really recommend 5% for most traders, but you figure out what you're comfortable with a calculator here. But now what you do not want to do is, a lot of new traders do this. They only have $5,000, but they're swinging like $1,000 for each of their position sizes. You don't want to do that. That's how you blow up really quick. Okay, so let's go back to $10,000. Let's say that's my account capital. I'm conservative. I want to risk only 2% per trade. That'll be $200. Okay. Now, let's say if I want to divide that max risk per trade into all my trades for the day. So you're going to change this into how many trades on average you take per day. So let's say I usually take 3 trades per day. So that means I can risk maximum $66.70 per trade. So this is very important. Calculate this and see what you're comfortable with. Now moving down to this area over here, we're gonna look at the risk per share. So you know the maximum
If you're a futures trader like me, that's risk per contract.
risk you can take, which is $200 per trade. So let's say I'm trading a stock, like a large cap stock like Tesla or Nvidia, where I need to risk $1 per trade, right? So that's, sorry, $1 per risk per share. Then how many shares can I take? Well, the calculator tells you that 200 shares maximum, according to my account size. Okay, and let's say you're trading a low float penny stock, you have to risk, something less, like.
So I like how she's doing this, and obviously it's very important to do the math. But the way that I approached this was this is a little bit conceptual for me, right? So what I just did is I said, instead of starting with max risk per trade, I started with how much can I afford to lose, or how much am I comfortable losing, right? So I would take that and then I would say, okay, that's my daily loss limit. Then I would take my daily loss limit and work backwards from there. So that's my approach. But this approach works too. Use whichever one works is going to work for you. But the point is, use a intelligent and math-based risk management approach. If you don't, you're screwed.
Like 50 cents, you type that in, then that means you can take 400 shares maximum. This is important because you want to make sure at least at the very beginning, from 6 months to a year as a new trader, you're keeping all your risk constant. This is how you make sure one loss doesn't wipe out an entire account.
Right.
Because a lot of people, they'll take way more share sizes on their losing trades and only take a small amount on the trades that they win. And really quickly down here, you can see the one.
And when you're still learning, you have no sense of what's going to be a winning trade and what's going to be a losing trade. So what you want to practice is just keeping that risk steady and consistent, trade by trade, and not varying it, right? You have to build and develop that consistency muscle.
1-to-1 risk reward profit target. Let's say, I'm risking 50 cents and the only profit target is 50 cents. 1-to-1 risk reward.
50 cents.
Yes, I could potentially make $200, but is it really worth it if I'm risking 200 to make 200? Sometimes it is, sometimes it's not. But what I try to aim for and what I would recommend you to aim for is 1-to-2 or 1-to-3 risk reward.
Yeah, and that's a good recommendation for all traders starting out, is try and go for 2 times your risk initially and try and do that as often as possible.
That's a PT stands for profit target. So if I'm risking 50 cents, I want to try to see if I can make $1 per share or $1.50. So that means I could potentially make $400 profit, risking 200, or $600 profit, risking 200 as well. And you can play around with this. Just input your own account size. Let's say you're trading $3,000 and then you're aggressive, risking 5%. This will be amount of risk you can take, and then maximum number of shares you can take if you're risking 50 cents. Obviously, that number changes depending on how much risk you're taking, right? Trading large cap stocks, you might have to risk $1 to $2. Small cap stocks, you may only have to risk. Most traders, myself included, when I first started, do the exact opposite. They only start planning their trades after they've gotten in. In my first year of trading, I used to jump straight into trades.
So we're talking about planning your trades.
Sometimes following chat room alerts like we talked about earlier. And then only after I'm in the trade, then I started to plan my profit target, risk, and then worry about, oh my God, what's happening now? What do I do? Like the younger Shay and most beginner traders, we tend to focus on trading just to make a quick profit, instead of trading the charts to make proper plans to follow. Okay, well,
right. So don't trade your P&L, because the market has nothing to do with what kind of money you say you want to make. It's based on price action. So she's saying trade the price action.
Back on TradingView right now, let me show you a very simple.
Okay, and I just want to say, she's talking about the importance of planning your trades, right? From the very beginning, I just said, okay, what's an easy way to do this so I don't have to think? Because when I'm trading, I don't want to have to think. I just want to be able to place the trade and think as little as possible, honestly. So I just use bracket orders. Easy approach. That's kind of like a hack with this. Set your risk up so that every time you enter a trade, your risk management rules are being respected with a stop loss and a profit target. And if you want to know how to do that in TradingView, you use this guy. There's a long position tool, and there's a short position tool, right? And so what you can do is you can just use, if you're going to take a short position, like let's say we wanted to get in on this move. Looks like we're coming back to test down here somewhere. So you would set this up and you would hit options on this, okay? And then you can set your default settings in here so that your max risk is respected with exactly how much you want to use. And then you'd enter, and it would automatically enter you with your stop loss and your profit target, which is your plan done for you. So that's the easy approach, is just use bracket orders. That's what I'd recommend, honestly.
Simple way to plan for your trades. That's gonna include your entries, key level, profit target, and risk area. So on the stock over here, you're looking at NVIDIA. You should always start with, doing some simple technical analysis and drawing your key levels. So you can see on this particular day, April 19th, the stock gapped down after a very strong day the day before. So we're looking at these 2 days here. This day in particular, April 19th. You can see it gap down due to no meaningful news. And then, a lot of times when the stock like these gap down with no news, I like to buy the bounce. So a lot of times, the key level will be if the stock is able to break through that pre-market highs area. Over here, you can see. And then once above it, it has potential upside to the daily highs. So yesterday's high of the day was around like 279's area over here, 279's. And that little wick on the daily chart you can see over here, that's 280. So we're gonna draw a line over there as well. And you can see intraday now, the stock was trading below the key level on here on the pre-market highs, and once it breaks out above that VWAP indicator, which we talked about early on, a very useful tool, then it has the uptrend to the upside.
Again, just like we were saying before, right? Price action was below the average here, right? Or VWAP. And then as soon as it crosses above, which right here, can you see that? It crosses. Now we get a big, strong bull close above the EMA, and then multiple closes above the EMA, shifting the market from bearish to bullish. And she's saying that's when you get long, and she's betting on a test of the high of yesterday, it looks like, right? And the high and the low of yesterday are two of the most reliable forms of support and resistance. So solid plan.
To the daily resistance like we talked about. So this is a very simple way to use VWAP to buy the bounce on this very simple strategy.
I like
You're
it.
looking for stocks that either
Simple works.
have gapped up or gapped down with no meaningful news. Once it breaks above VWAP, if it has good upside, in this case to 279, 280, then you buy the pullback on each one of these dips once it's above VWAP, okay? Not below it, has to be above VWAP. So let's say I'm looking at trading
Because that means bullish.
the stock midday around 10:50, 11 o'clock. I see it trading above VWAP, right? Above VWAP over here after some consolidation. And remember, if a stock is trading above VWAP, it's bullish.
Hey, I just said that.
Especially it has more upside. So I see the upside to 279, 280s. And over here, it's over pre-market highs and over that VWAP area. So let's say I want to buy it here.
Now, why? She doesn't say why. Why, if the price is above VWAP or above the EMA, same thing, more or less, why is it bullish? Because that means traders say, oh, the price is going higher. They think that the market is valuing the price. It's undervaluing the price. Because the only reason why anyone would ever buy is because they think the price is going up. That means long. That's what long means, right? So every time it gets to the moving average, traders buy, which shows you that the overall bias is long or bullish.
I want to buy it here around 276, as close to VWAP as I could, 276.50s. And if the strategy is to buy the dip along VWAP, I know my risk needs to be below it, but not just right below VWAP. I want to give it, let's say, $1 room for a stock like NVIDIA. That's very necessary. So if I'm risking below VWAP over here,
So she's putting her stop loss here.
So this is like what, 70 cents, almost $1 per share. So I'm gonna make this red. So this is going to be my risk.
Perfect.
This is my entry, the yellow line. And then I know upside has room to 279, 280s that we talked about. So in this case, I'm risking $1, right? I'm risking $1 here for the potential upside to make, this is what, $2.50. So this risk reward is 1 to 2.5. And if it goes to 280 or 281s like we planned out, which it doesn't always go according to plan, then it's gonna get us 1 to 3 and more, 1 to 3.5 risk reward. And this is how you do the most basic trade planning process. You need to do this before you enter the trade. You have your entries, your risk, and your potential upside. If you were just do
Right. And Obviously, you can also just use bracket orders, which I showed you, which is even easier.
Do this for all your trades starting out tomorrow, you will be surprised how much better you can perform as a trader. Trading without
It really helps with the it really helps with the mental game as well, right? It helps keep your emotions calm because you know where your risk is, you know where your target is, and you can just chill and relax.
the plan is like going to war with empty hands or getting married without a prenup. I'm just kidding, okay? Okay, that might be a really bad joke. If you really want to eliminate emotional trading, over trading, or revenge trading, this is a #1 rule to follow. I promise you, by planning your trades and trading your plan, you're gonna be way less emotional, have less FOMO, and you are gonna have a lot more confidence as a trader.
100.
While I cannot make all of your trading plans for you, you can receive my weekend watch list with some potential trades
That's
for the
cool.
next
She's
week.
got that.
The trade planning we just did. And if you want to receive these free weekend watch lists, you can sign up through the link down below. It's the same link you saw earlier. Once you signed up, you're gonna get a free trading journal, the risk calculator. You are really. The fourth trading rule I have for you came from my early years in trading, and I'm pretty sure some of you are really experienced in this. Yes, that's blindly following chat room alerts
Oh
or
my God, yeah, please don't do it.
signals or copy trading. I was once a trader who subscribed to multiple chat room alerts while talking about small caps, low floats, penny stocks, big caps, options. And I would blindly follow alerts to place trades without knowing any of the reasoning behind them. And while I have made some small profits successfully following alerts, during the times when the alerts were wrong, I lost everything and more. Essentially, I was making small wins but big losses. And here are the real dangers with copy trading and following chatroom alerts. You're receiving signals from traders who have already made their move, meaning most of the time they have already bought in the stock and have gotten the ideal entry. And if you're just following them, your entry is always gonna be a few seconds behind. And if you're trading these low float, small cap stocks, a few seconds can mean a big difference. Imagine this. Bob, a trading signal seller, bought the stock ABC at $1 per share and told his 100,000 followers on Discord the signal to start buying right after he did. Everyone will attempt to buy the stock at the same time, and that's going to increase the price in a short amount of time artificially. So there might be new traders getting in at 105, 110, or someone would be that dumb schmuck like I was, buying at 140.
And that's how she lost $70,000.
And if the stock is a low float, the chances of this happening is even higher. And when Bob is finally ready to sell at 150, guess what happens? Do you think all 100,000 followers will get to sell at 150 or even at 120? That's rarely the case. Sadly,
And then you get left holding the bag. This is what happens with crypto, right? That's what they call that rug pull. That's that rug pull.
these people, often new traders, they're probably the ones buying the shares that Bob have just sold at 150. These people will have to sell their own shares for a loss much later on, as the price is driven downwards once everyone, all 100,000 followers, are trying to sell at the same time. Does this scenario sound kind of familiar to you? Yes, you should have been aware by now of the 100 million pump and dump scheme by a group of stock market influencers late last year. These influencers had huge followings on Twitter and free Discord groups, and they were pumping many of these low-float small-cap stocks to their followers, and then they would sell their own shares to them and make massive profits.
It's so messed up. And then you're leeching money off your audience, and then you're screwing them financially. It's so effed up.
I hope none of you ever have to experience this with your hard-earned money, because number one, you won't know how to plan your own trades.
That's another good point, right? If you do that, even if it does work, you still won't actually be learning anything. And now you're a slave of these trading signals, which really is trying to shortcut the learning process and won't work in the long run anyway.
And ever trade sufficiently on your own. And number two, you will never have proper risk management.
Oh yeah, that's a whole other thing, right? You won't actually learn how to manage your risk, which is the most important skill in trading anyway.
That's the reason I taught you how to do both of these things early on in the video, so you won't need to resort to following chatroom alerts in order to day trade. The key takeaway here is avoid chatroom alerts or text alerts, like how I avoid my ex-husband, Mike Bagholder, 500 feet away. And really learn how to trade the
She's funny, man. I like it.
right way for yourself. And by that, I mean come up with your own trading plans, risk management profile, and make your own informed decisions.
Yeah, look, you can't be hoping to find some daddy that's just gonna do it for you and like make it all better. It's like you gotta be the daddy in trading. You got to be the big daddy. You can't be a child beholden to some other person who you think knows better. You got to own it. You just got to own it and be like, yes, I'm going to learn this so I can make my own decisions for myself. It's the only way.
When you rely on following chatroom alerts, you're essentially handing your money over to someone else. Remember, I have to do so for my ex-husband, but you don't have to. Going back to the first trading rule to become a profitable trader, only use 1 or 2 indicators.
Let's review them one more time. 4 rules for consistently profitable trading. The first one was only use 1 or 2 indicators, right? Only use 1 or 2 indicators. She uses VWAP and volume. I use the ATR and the 20-period moving average, exponential moving average, okay? Now, the second rule that she said was focus on price action. This was a takeaway, right? But this is the reason why you should actually understand what your indicators are doing, right? Because the indicators are reading the price action. They're helping you read the price action. So focus on price action means understand what is happening when you look at a chart. Can you look at this chart right here and see that there's a massive sell-off, right? And then we had a major trend reversal to the upside, right? Can you see that? And then if we zoom out on this, this was actually a greater bull trend, okay? So this is in the greater context. This is a pullback of the greater bull trend, right? Look at a chart and be able to do that. Then you can use your indicators and you can have them help you, right? But it's not a replacement for learning. Indicators are not a replacement for learning, okay? Now, her second takeaway is to take your time with sizing. And we just said, slow and steady wins the race. Slow and steady wins the race. And I promise you I've made that mistake. So I'm going to say it over and over again. Slow and steady wins the race. And if you don't go slow enough, you'll blow up. So remember that one. She offered this cool calculator to kind of make her point. You need to understand how much you can risk per trade and then how many trades you're going to take so that you know how much you're risking on a daily basis. Now, what I did for this is I set myself a max daily loss limit, a maximum daily loss limit. And then I didn't really have to worry about exactly how many trades I was taking. I just said, okay, if I lose this much, that's it for the day. And that ends it. And that worked for me. Her third rule is always have a trading plan. My recommendation for that was to just use bracket orders, right? It keeps it very simple. You always enter and always enter with a profit target and a stop loss, right? And that keeps it real simple. And then you just respect it. And then her third takeaway is plan your trades and trade your plan. Like I said, use the cheat code. Well, it's just a suggestion, right? You can use the cheat code for trade planning, which is bracket orders. It's a great tip, okay? And avoid the pump and dumps and don't buy indicators, right? You will not know how to plan your own trades. And that's her 4 lessons after losing well over $47,000. If you want to get more information on my setups, go to the link tradesbybren.com/3 setups, and I offer you my 3 setups as well as a very detailed breakdown of examples of the patterns that I look for when I trade, including how I set my profit target and my stop loss. And hit the like button if you like the video and subscribe if you want more.